In today's video we are going to talk about put options, what they are and how we can use them. This is the second episode in a three-part series covering the basics of options trading. In the first episode we looked at call options, in the third we will explore selling puts and calls. Before we dive in, make sure to check out optionwise.eu for more content like this. You can sign up for a newsletter and grab a free ebook Options 101, your first step toward smart trading. It's perfect if you are just starting out. And if this video helps you out, don't forget to like, subscribe and share it with others. It really helps the channel to grow. Here is what we will cover today. I will start with a simple definition of a put option. Then I will share a real-life example of how a put option works in everyday life. We will look at the risk profile of a put option. I will show a speculative trade using Microsoft stock and compare it with trading the shares directly. We will analyze the risk and return on that put option. Finally, I will explain how a put option can also serve as portfolio insurance for a stock holding. An option is a contract that gives its holder the right, but not the obligation, to buy or sell something like shares at set price at a future date. A call option gives the right to buy, a put option gives the right to sell. When you buy an option, you pay a premium for that right. If the price of the asset moves in your favor, you can profit. If it doesn't, your loss is limited to the premium you paid. Options are derivative instrument, which means their value is based on the price of an underlying asset. Options can be based on stocks, indices or future contracts. There are two types of options, calls and puts, and with each option you can take one of two actions: buy it and hold the right, or sell it, also called writing an option, which means taking the obligation if the buyer decides to exercise. Let's start with a simple real-life example of how put option works. Imagine you are the proud owner of a single-family home worth around 350,000 euros. Naturally, you decide to protect it with an insurance, in case of a fire, flood, or any major disaster that could significantly reduce the value of your property or even destroy it entirely. You purchase a one-year insurance policy and let's say the cost is 1,500 euro per year. Each year you renew the policy. If nothing happens, it simply expires unused, and you renew it again. But one year a fire breaks out and causes 100,000 euros in damage. Your property value drops to around 250,000 euros. The insurance company steps in and covers the damage, helping you restore the value of your home. That insurance contract is equivalent of a put option. If disaster strikes, you use it. If it doesn't, it expires worthless, but gave you a peace of mind. The same principle applies to stocks. A put option on a stock works like an insurance against a drop in value. We will cover this in more detail later in the video. Unlike in the previous video, where we started with the call option definition and use case, here I would like to begin with the risk profile of a put option because understanding how it behaves is crucial and also a bit less intuitive than with calls. Put option is a contract that gives its holder the right to sell a specific asset at a set price by a certain date. Unlike a call option, which gains value as the underlying asset price goes up, a put option increases in value when the asset price falls. The maximum value of a put option is reached when the underlying asset drops all the way to zero. That's just like in the earlier home insurance example. If the house burns down completely, the insurance pays off its full value. You could say that the more damage the house suffers, the more valuable the insurance becomes, because it allows you to recover the loss and rebuild. In trading terms, if the asset price doesn't fall or even rises, your loss is limited to the premium you paid for the option. Going back to the insurance analogy, if you paid 1500 euros for 1 year insurance policy and nothing happens, or even better, you discover a vein of gold or the amber room under your house, you still won't get more than what you paid for. Let's now move on to the put option contract, a type of option that gives the holder the right to sell the underlying asset. Just like with a call option, a put option on a stock must include several key parameters. Contract price, also known as a premium, this is the amount you pay for the option. Contract size, multiplier, for stock options this is typically 100, meaning one put option gives you the right to sell 100 shares. Strike price, the fixed price at which you have the right to sell the underlying stock. Expiration date, the final date the contract is valid and the option can be exercised. Out of these parameters, only the contract price, means premium, changes throughout the life of the option. The multiplier, strike price and expiration date are fixed once the contract is established. Let's have a look at the example. Let's say that on September 1st, Microsoft stock is trading at $430. If you expect the price to decline instead of opening a short position on the stock, you could buy a put option at the money, which means the strike price is close to the current stock price. Let's break down the contract. Put option on Microsoft stock. Price $20. Number of shares 100. Strike price $430. Expiration date October 15th. As the holder of this contract, you have the right to sell 100 shares of Microsoft at $430 at any time before October 15th. To buy this contract, you pay €2,000. Why? Because the quoted price of $20 per share and the option controls 100 shares. $20 times 100 shares equals $2,000 premium. If the price of Microsoft drops as expected and by October 15th it trades at $370, your option gains $60 of intrinsic value per share. With the 100 share multiplier, that's a 6,000 total value. Why? Because you have the right to sell 100 shares at $430, while the market price is only $370. You could buy the stock at $370 and sell it via the option for $430. Or simply sell the option contract itself for $60 per share equals $6,000 total. Let's have a look on the trade summary. You paid $2,000 for the option, you gained $6,000 on the price move, your net profit is $4,000 because you have to subtract $2,000 paid from the $6,000 gain. Your return on capital is 200% and effective leverage is 21:1. The alternative scenario to buying the put option would be to short 100 shares of Microsoft on October 1st at $430 and then buy them back on October 15th at $370. In this case, you commit $43,000 in capital. Your profit would be $6,000, which is more than in the option example since you don't have to pay the premium for the option. However, your return on capital is just 13% and you didn't benefit from the leverage. Now let's consider the opposite scenario. To complete the picture, let's see what happens if the stock price rises above the strike price by expiration. Imagine that on October 15th, Microsoft trades at $480. In this case, exercising your put option makes no sense. You would be selling shares at $430 when market is offering $480. If you were to buy shares at $480 and sell them via the option at $430, you incur a $5,000 loss. And after adding the $2,000 premium you paid for the option, your total loss would be $7,000. But here is the important part. With an option, you are not obligated to exercise. If the market moves against you, you can simply let the option expire worthless, and your only loss is the premium, in this case $2,000. And that's the power of the option. You use it only if it benefits you. What if you shorted the stock instead? Let's compare this scenario to one where you don't use the options at all. If you short the stock at $430, you are committing $43,000 of capital. If the stock later rises to $480, you are facing loss of around €5,000. Earlier in the call option video, I mentioned that when you own shares, you are not forced to realize the loss. You can simply hold the stock for as long as you want, hoping it recovers. The same idea technically applies to short positions. You could hold them too, but in practice that's rarely a good idea. If the trend has reversed and the price is rising, holding onto a short position in hopes of a crash can be a recipe for a serious damage to your account. Now let's take a closer look at the risk profile of a put option using the example we discussed earlier. This is a chart that shows how the option value and your potential profit or loss changes depending on the price of the underlying asset at expiration. Using our Microsoft put example, we can highlight three key characteristics. Maximum loss is limited to the premium paid $20 per share or $2,000 in total, and it won't increase even if stock price soars. Maximum profit is capped. It occurs when the stock drops to zero. That's the limit of the upside. The break-even point is the strike price minus the premium paid. In this case, $430 minus 20 equals $410. If the stock falls below this level, the position becomes profitable. This explains why even if the stock drops to $370, you don't profit from the full $60 difference between the strike price and the market price. You have to subtract the $20 premium, so your net profit is $40 per share. Let's finish with an example of how a put option can be used as insurance. Imagine you currently own 100 shares of Microsoft. On September 1st, the stock is trading at $430 and let's say you are sitting on a solid unrealized gain. If you are concerned that the stock might decline, perhaps due to potentially weak upcoming earnings, you might want to protect the value of your position. To do this, you could buy a put option at the money, meaning the strike price is close to the current market price, as a form of a hedge. Let's break down the contract. Put option on Microsoft stock. Option price $20, number of shares 100, strike price 430, expiration date October 15th. By holding this option, you now have the right to sell your 100 Microsoft shares at $430 at any time up to October 15th. This means that if something negative happens, such as disappointing earnings, and the shares price crashes, you can still sell your shares at $430 no matter how low the stock goes. For this protection, you will pay a total of $2,000, that's $20 times 100 shares. Now let's say Microsoft announces poor results and the stock drops to $200. Your put option would be now worth approximately $130 per share, which translates to a total value of $13,000 including the multiplier. At that point, you could exercise the option and sell your shares for $430, giving you time to decide whether or not you want to continue holding Microsoft in your portfolio. On the other hand, if the stock doesn't crash after earnings, you could sell the put option before expiration and recover part of the premium, though likely not the full amount you paid for it. This scenario is different from the earlier examples because here you are using the put option to protect shares you already own and your motivation is risk management, not speculation. A put option is a sell option that gives the holder the right but not the obligation to sell the underlying asset at a specific price. Every option contract includes key parameters such as premium, multiplier, strike price, and expiration date. Options offer leverage, which means more efficient use of capital. We buy put options when we expect the market to decline, and they can also be used as an insurance to protect stock position against losses. The main advantages of put options are built-in leverage and limited risk. The main downsides: you subtract the premium paid from your potential profit. Options expire unlike stocks, which you can hold indefinitely. As mentioned at the beginning, with a put option you can either buy it or sell it. In this video we covered what happens when you buy a put option. In the next video we will dive into selling options, both calls and puts, and explore how that completely changes the risk and reward profile. If you found that video helpful, give it a like, subscribe to the channel and share it with someone who's starting their journey with options. For more content, frameworks and examples, visit my blog at OptionWise.eu. You will find articles, tools and free resources to help you build clarity and structures in your trading.